The news says unemployment is 4.1%. The economy is strong. The labor market is resilient. But what if that number is hiding something? What if I told you the exact same pattern happening right now in the labor market appeared right before the 1974 recession, the 2001 crash, and the 2008 financial crisis? And almost nobody is talking about it because the headline number looks fine. By the end of this video, you'll understand the one labor market signal that has preceded every major American downturn since 1970, and it just flashed again. Here's the thing about the unemployment rate. It counts you as employed if you worked even 1 hour in the past week. So let's say you had a full-time salaried job paying $75,000 a year. You get laid off. You can't find another full-time role. So you pick up 12 hours a week at a warehouse for $17 an hour. Congratulations, you are statistically employed. The unemployment rate does not budge. Not even 1 decimal point. That is the flaw baked into the headline number. And right now, that flaw is doing a lot of heavy lifting. Let me show you what's actually happening beneath the surface. Over the past 12 months, full-time employment in the United States has dropped. Not grown, dropped. By over 1 million positions. Meanwhile, part-time employment has surged by roughly the same amount. Now here's the critical detail. The Bureau of Labor Statistics tracks something called involuntary part-time workers. These are people who want full-time work but can only find part-time hours. That number has been climbing steadily. These aren't college students picking up weekend shifts. These are adults, many of them in their 30s and 40s, people with rent, people with kids, people who had real careers and are now cobbling together gigs. And here's why you should care. Every single major economic downturn since 1970 was preceded by this exact shift. Full-time jobs quietly eroding, part-time jobs quietly rising. While the headline unemployment rate stayed deceptively stable, let me walk you through it. In late 1973, unemployment was around 4.8%. Not amazing, but not alarming. Headlines were fairly calm. But underneath that number, full-time employment had begun to soften. Part-time work was ticking up. The shift had started. Then 1974 hit. The recession, oil shock, stagflation. Millions of full-time jobs vanished in months. By the time the unemployment rate finally reflected the damage, it was already too late for a lot of families. Same story before the dot-com crash in 2001. Unemployment was around 4% heading into 2001. Looked solid on paper. But full-time employment growth had stalled. Part-time work was expanding. The foundation was cracking before the market noticed. And before the 2008 financial crisis, same pattern. Full-time jobs began declining in early 2007. Part-time jobs surged. The unemployment rate didn't spike until the crisis was already well underway. 3 different decades. 3 completely different economic environments. But the same early warning signal every time. Full-time jobs shrinking, part-time jobs growing, headline unemployment pretending everything is fine. And right now, today, that signal is flashing again. Let me put some real numbers on this. 4.1% unemployment, that is the headline. But over the past year, the economy has lost roughly 1 million full-time positions and gained roughly 1 million part-time positions. Do you see the problem? The net employment number looks flat. The unemployment rate stays low, but the quality of those jobs is deteriorating. And that deterioration matters enormously. Let me show you what this looks like in real human terms. Let's say you are making $75,000 a year, full-time, benefits, PTO, the works. You get laid off in a round of cuts, you search for 4 months, nothing full-time opens up. So you take a part-time role paying $17 an hour at 25 hours a week. That is $22,100 a year. Before taxes, you just lost over $50,000 in annual income. But statistically, you are employed. The economy added a job. The unemployment rate stayed at 4.1%. Now multiply that by hundreds of thousands of households. That is what a labor market deterioration looks like from the inside. Not a sudden spike in unemployment, A slow, quiet erosion of job quality that the headline number was never designed to capture. And here is why this matters for you specifically. If you are a millennial, you have already been through the economic ringer. You graduated into the aftermath of the 2008 crisis. Entry-level jobs vanished. Starting wages were depressed for years. You delayed buying homes. You delayed starting families. You carried record student debt into a labor market that did not reward you. Then COVID hit. Another disruption, another reset. And now, just as you are hitting your prime earning years, your 30s and 40s, the ground is shifting again. Here is what happens when full-time jobs convert to part-time jobs at scale. People stop buying cars. They stop qualifying for mortgages. They stop spending on non-essentials. And since consumer spending makes up roughly 70% of the U.S. economy, that pullback ripples outward fast. Less spending means lower revenue for businesses. Lower revenue means more layoffs. More layoffs means even less spending. The cycle feeds itself. And the cruel irony is that by the time the unemployment rate finally ticks up to 5 or 6% and everyone panics, the real damage happened months earlier in the part-time shift. The full-time to part-time shift is the canary in the coal mine, and the canary has been coughing for months. So what do you actually do with this information? First, if you currently have a full-time job, recognize its value. Do not treat it as disposable. The full-time positions being lost right now are not being quickly replaced. Job hopping for a small raise might carry more risk than it did 2 years ago. Second, build multiple income streams before you need them. Not motivational speaker side hustle nonsense. Real practical skills that someone will pay for regardless of economic conditions. Third, build a cash buffer. If the labor market continues deteriorating, finding a replacement job will take longer than it did in 2021 or 2022. A 3 to 6 month emergency fund is not paranoia. It is insurance against a shifting market. And fourth, stop trusting the headline number on its own. Go to the Bureau of Labor Statistics website and look at the data yourself. Specifically, look at the U6 rate. It includes involuntary part-time workers and discouraged workers. It gives you a much more honest picture of the labor market than the headline 4.1%. The U6 is always higher than the headline rate, but when it starts rising while the headline rate stays flat, that is the divergence that matters. That is the signal. Here is the bottom line. The 4.1% unemployment rate tells you how many people have zero income. It does not tell you how many people are watching their income get cut in half. And historically, the shift from full-time to part-time employment has been the earliest reliable warning that a labor market downturn is underway. Not a prediction, not a theory, a pattern, repeated across 5 decades. The question is not whether the pattern exists. The data is public and clear. The question is whether you take it seriously this time, or whether you wait for the headline number to confirm what the underlying data has been screaming for months. If this was helpful, there's more on the channel.